Once you know the total initial outlay, including working capital and a contingency fund, you're going to need to know how to fund it. Funding the total investment will likely involve both equity and debt. Debt, while great to avoid, is invariably needed. But before considering debt, you should carefully evaluate what equity you could raise. As a prospective franchisee, you may have many sources for both equity financing and debt financing. Possible sources of equity financing are varied and may include the value of cash and near cash assets, like term deposits or shares that you have at your disposal. Other assets you could sell, like a spare vehicle, equipment, or even a batch. Friends or family who may also be interested in investing or even partnering in the business. When considering debt, most people think first of bank funding. However, there are many potential sources of debt financing, one of which includes bank funding. Banks, typically by way of a business term loan or mortgage security. Many may also provide other financing options, such as asset or equipment financing. And note that some franchisors will have strong and helpful relationships with banks based on a solid track record. Finance companies. Many finance companies provide different forms of debt finance, covering areas like loans, assets or vehicle finance, and invoice finance. The franchisor. While still relatively rare, franchisor financing options have become more common, particularly in more recent years. Examples of franchisor financing has included deferred payment of part or of the entire initial franchise fee, inventory or stock loans, van or equipment leases, lines of credit or loans, and suppliers. Similar to some franchisors, some suppliers may loan stock or provide lenient payment terms. And friends and family. Obtaining support from friends and family is another source of investment and a way to help fund your franchise. Your aim should be to borrow the minimum necessary in the most cost-effective way while still ensuring you have sufficient working capital. A key question for you and the bank is how much can the business afford to repay, which is debt servicing, while still allowing you an adequate salary and return on investment. You must take advice from an experienced accountant to work this out and will need to include any tax implications when making the calculations. You should also seek the advice of your accountant and potentially your financial advisor, if this is separate, when considering and finalising how you fund your business. Visiting the bank. Visiting the bank is a really important phase in the franchise purchase process. The bank, like you, is interested in the success of your venture, and accordingly, they will want to have confidence in you and your support network, your ability, the structure of the franchise opportunity, and your proposed plans. That means that preparation is vital. Your success is likely to be greatly enhanced if you have developed a clear understanding of the following: yourself, including your capabilities, and support networks, including family, friends, and advisors, your financial position, including net worth, details of the franchise opportunity of focus, how you expect the franchise business will develop financially, and how you intend to make that happen. The next interview will help you understand bank funding for a franchise purchase from a bank's perspective, including when you should contact the bank, what preparations you should undertake, what accreditation means, what lending options are available, and what you can learn from the mistakes of others, and funding a greenfield or new franchise opportunity versus funding an existing franchise.